Good morning, good afternoon, good evening, folks. How you doing today? Michael Zuber, one rental at a time. And it is Monday. You know what that means. That means we speak to the one and only Greg Dickerson. How you doing, sir?
Doing fantastic, Michael. How are you today?
I'm doing wonderful, man. We got some exciting topics today. And the first thing I want to do is I want to bring up something I've been working on as kind of a pet project. And what I've been doing is I've been researching the last 40 years of housing. So basically 1980, 85, 90. So every 5-year period. And what I was trying to figure out, this was my question to myself, Greg, is what year was housing most expensive for the average family of four? So average house, average family of four. Again, everything here is national because I couldn't pick regional. I don't know that the data exists regionally that far back. So national housing prices, average interest rate, average income family of four, when was housing most expensive? So that's what I was trying to figure out. And I didn't know the answer. Do you have a guess actually when you think about that?
I'm going to say 70s.
Oh, I only went back to 1980. I'm sorry. I haven't gone back that far, but I may go back
Oh,
further.
80. Okay. Yeah. So from 80 onwards, I'm going to say 90s, 89, 90, late 80s, early 90s. Before
Okay.
that, it would have been the 70s.
Okay. All right. I may actually go back and update the data to go back even farther. People have often guessed the 70s. So maybe I should have
Well,
gone
that's
back
because
further.
that's when you had, like my parents, their first house, I mean, interest rates were like 19, 20%.
I need to go back further. I could do that. So maybe I'll make it
So as
50
far
years.
as when you say most expensive, what that triggers in my mind is affordability index. So
Yes.
that's where I'm. So the houses may not have been more expensive in relation to, obviously the prices are lower if the interest rates are higher, but your payments higher. So from an affordability percentage of income standpoint,
Yeah.
that was probably one of the most expensive time frames, at least in my world. Now I don't know, I don't really study housing before the 70s. That's kind of
Yeah.
as far back as I go. But
Fair enough. I may actually add those, 1970 and 75, because I think that would be interesting because those are the
mhm,
years of stagflation. So it could
mhm.
be it could be interesting, especially if we think stagflation is on our future. So you know what? I'm going to add those periods. That's only two more pieces of research. All right. Well, let me bring up the spreadsheet, and actually, it will probably surprise you. All right. So hopefully you can see that. I'm actually going to move us. I'm going to collapse our view. Actually, you know what? I think I can just show you. Yeah, there we go. You see it? Greg, do you
Yep.
see? Okay, cool. So let me just orient you to the columns, and then every column is the same. So I went back and found the median home price in 1980, 55 grand. Interest rate in 1980, again, I Googled that, was 13.74. What I assumed for down payment, and this is something brand new, no one has seen this because I got a lot of feedback. I assumed in this example the down payment was 20%. You see that here?
Mhm.
So 20% of 55 grand is 11 grand. You're going to then finance it. So you're going to finance 44 grand. Simple math, right? I then did the payment calculation, assuming 13.74%, and this finance amount equals 512. Again, this is median income for a family of four in 1980 for the country, not regionalized. So for the country, it was 21 grand. I then divided that by 12 to get gross income. So it's not net, it's gross, because I didn't know the marginal tax rates back in the 80s. So I just used gross. Right now, the payment, so 512 is 29, basically 30% of gross income. And then again, feedback I got from the audience was, tell me about the down payment. So right now, the down payment of 11 grand is 52% of the median family income. So I did that for each period. So let's fast forward to 1990. So 1990, the average home price was 97 grand. Interest went down to about 10%. Down payment, again, 20% of that is 19.4. Financed amount, payment amount, family of four's income went up about 50%. Now their gross income is 2,500. Their payment to gross is 27%. So it went down a little bit, but the down payment is
Mhm.
climbing. So let's jump forward to like 2005, right before the bubble, right? Prices since 1990 basically doubled. So they're 191. Interest rates are in a half. That's one of the things I realized in this, is that interest rate has an outsized impact. Down payments.
Yeah, that's what I've been talking about. And I always have been all the way back since 04, 05. I was screaming interest rates and nobody listened. Everybody's like, you're crazy. Interest rates have nothing to do with it.
Oh, it's all, I mean, what you're about to see is interest rate has everything to do with it. which I didn't appreciate, to your point, and good for you calling that out. So again, payments now are 906 because you're financing a lot more, but the rate's cut in half. The average family income now is 58 grand. So 15 years basically doubled. Your gross income for the month, because I need to get to a monthly payment. So now your payment to gross is 18%, right? All down from 27. But the down payment now is almost 66% of income. Make sense where we are? So now if we fast forward to 2020, payments, or the house is up 80 grand. So now it's 270, but man, look at that interest rate, 2.89, down payment, all the same stuff. But now look at income is 78.5. Again, family of four. This is not an individual. This is family of four, likely two incomes. $6,500 a month. Again, just simple math. Now your payment's 13%, 13.7%. And then the down payment is, I don't know, 69%. So this is pretty crazy, because when you do the math through 2020, it's cheap. It was never cheaper than 2020, again, on an income level. I think these numbers are staggering, but it is so interest rate related.
It is. It's always has been. I mean, the cost of your financing is pertinent and paramount in any deal. Doesn't matter what kind of deal you're doing. It's all about the financing. And that's why I said 80s, late 80s, early 90s. I knew that was going to be the highest as far as an affordability index, because the interest rates were just way higher. And then they didn't really start coming down until that 2000 timeframe.
Right.
And I remember when we started reaching the peak of our market, 04, 05, I was writing articles all the time.
Yeah.
I wrote a regular column for a newspaper down there and was interviewed a lot. That's when I was on the Cavuto show. No, that was the 08, 09 timeframe. But I warned about interest rates, and I said, look, all you got to do is watch them. Back then it was 5%.
Right. You were right.
We got down below 5, and I said, as soon as we get back to 5% or up, it's going to tank the market, and it did.
Yeah. There's a lot of great data in this, and I don't know what I would call it, intuition or experience was dead on, and this data just validates it, right? So there's a couple of things I've added to this because people have been looking at it and said, what the hell kind of stuff. So a couple of things. First off, I added July 2021 data, and actually you see a couple of changes. Mm-hmm. So first off, prices are up a lot. We just talked about this, 363 as the median. Interest rates were down slightly in July. But a couple of things you notice here. The big one. So first off, we hit a low in 2020. They're going up now because prices are accelerating so fast. And then second, this is the big bugaboo for me. The down payment now is 91%. That's a problem, right? It's never been above, what is it? Highest it was 73% back here. And now we had a spike. So this is telling me that housing has seen a big spike in 2021. Does that seem reasonable?
Yeah.
Yeah. So, okay. So a couple of things, right? Because I get a lot of feedback. The first feedback is, hey, Michael, nobody does 20% down. We only do 5% loans, all of that. You're being unrealistic, blah, blah, blah. I'm like, fine. So this is what I did this morning. You're the first person to see this. So what I did is I made the down payment a variable that I could change in one cell, and it ripples through. So what I did is, now let's assume it's 5%, because that's what everybody was telling me to do. So I've never done this. I'm going to see this the first time. I expect what's going to change is row 7, because that'll be the payment. Actually, wait, row 5, the down payment will change. The finance will change. And then what I'm really looking for is row 10 and 11. That's going to be the ones for me. So here,
5% down, the only people doing that are first-time home buyers. Nobody's getting 95% loans on.
Yeah. I just wanted to see. Everybody was complaining in my notes, hey, let's do an owner occupant. You're talking investors with 20%. Let's talk owner occupant.
And I don't even know that you could do that pre-2000. I don't think there were 95% loans pre-2000. There might've been. I'm
so glad you brought that up. I spent an hour yesterday. Folks, if you're watching this and you can send me a link to when the first time 3.5% down loan was created, I would love to see that. I spent hours yesterday on the couch trying to Google that data, and I couldn't find it. When the 3.5% down first time buyer program was created, I could not find a start. So if you can find it, folks, let me know. But let's just assume.
back in those days, late 80s, early 90s. So I bought my first house in 1990, and I remember interest rates were way high. They were around that 10%. So we bought on what's called a 3-2-1 buy down, where your interest rate was lower the first year, goes up the second year, goes up the third year. The idea was your income should grow over the next 3 years so that your payment can go up.
Huh.
And the other thing that was being offered was developer kickbacks to get people into the house and to help with down payment assistance.
Oh, wow.
So those types of things were there. But anyways, I didn't
Yeah.
mean to interrupt you there,
It's
but
okay. I like it. It's just, I have no idea what's about to happen because I have not done this yet. First off, I hope the math works. Oh, cool. It did. All right. So first and foremost, if you do a 5% down, the first thing I look at is row 10. You're 35%. You're getting there's no bank. There's no bank that will approve you at 35% of gross, because that's probably like 42 or 43% of net for your mortgage. So the first thing that tells me is you're probably right. There were no 5% down loans back here back 80, 85,
Yeah.
90. That's crazy. Down payment's a lot more reasonable though. I tell you, it's a lot easier to, 13% of income for the down payment, because your down payment's $2,700 back in 1980, assuming you could get a 5% loan. So let's fast forward to 2005. Let's see what we're doing here. All right. So 2005, your down payment's only $9,000. All right. 10 grand, maybe. That makes sense, right? 5% of 200 grand. Your payment though is 22%. And then your down payment is 6. Yeah, you're still reasonable. So let's fast forward to today, because that's where the spike happened. Oh, it's still not too bad.
Yeah. Yeah, it's not too bad.
Yeah.
It's interesting because I remember when I got my real estate license, back in the 2000s, early 2000s, we were doing a lot of these calculations, and the rule of thumb back then was you could the affordability, you could afford 3 times your annual income. That was the threshold. And your debt to income ratio was like 30%.
Yeah.
So if you made 100 grand a year, you would qualify for a $300,000 house. That's kind of how that worked.
Yeah. Yeah. What I take from this, again, if you're doing a 5% down owner rock, I would tell you the housing today, even in this spike in 21, is affordable, right? It's 20%. That's your payment, 20% of your income. That's reasonable. That's one in 5. And then the down payment's very reasonable. It's 22%. It's only 18 grand. So
yeah, and if you're a first-time buyer, you can get assistance and programs where you can put 3 to 5% down on your first house. And we've talked about that. The only thing driving the housing market, are interest rates, and especially with millennials, because they're like, man, it makes 0 cents to rent when I can afford pay the same payment and own.
Yeah. So here's another thing, because I knew I was going to talk to you. This is something I built yesterday, because you and I both believe that at some point interest rates, back to our earlier point, will destroy housing, right? So what I did is I just copied July 21. So I just took the columns from over here to here. And then I played what I call the what if game. The only variable I changed was interest rate, right? 4%, 5%, 6%. And I just let them ripple through. I assumed 20% down for this because, again, investor loans. So what you find is at 4%, we're basically 21% of gross. So that brings us back to kind of 2000-ish, right? So again, I would ask, if you're watching this, was housing affordable in 2000? And most people would say yes, right? So at a 4% interest rate, I think housing is still okay. 5%, again, everything stayed the same. Value, income, all of that. You're now at 23.5% of gross. So if you go back and look at the math, 23% takes you back to right around probably 94, 95, 93, 94. Again, I would ask, was housing affordable in 94, 95? Most people would say yes. And okay, now I think housing blows up at 6%, right? It hurts my head to think that high, but I did the math. 6%, again, it only takes payment to 26% of income, the average income. So 26% takes you back to, I don't know, 91, right? This number right around here. So again, was housing expensive in 1990? And you can see it can obviously get more expensive. But yeah, I mean, I thought that was an interesting exercise.
It is. And the thing to look at, so 4% your number now. 4% will tank the housing market in terms of demand. When I say tank, the market's not going to crash overnight, but it's going to tank demand, which will take a while to trickle through.
Exactly.
5% would be disastrous, but 4% is where the tipping point is now. And it might even be 3.5, as we've seen lately, because now we're sub 3%. It's mental thresholds and conditioning, just like stocks with those mental, points of resistance and support, price points. Here's what you need to do now. Is the thing that you've held constant is the value of the house. What you need to do now is hold the payment constant and show how that affects the value of the house based on interest rate. So for every 1% the interest rate changes at the same payment, the house goes up or down. You see what I'm saying?
Yeah, I can do that.
So I'd add a column for that so that people can really understand what we're saying when we say the housing market's going to crash if interest rates go up. Because if all you have to spend, let's take at 4%,
Yeah.
if you have $1,300 a month to spend, and that's all you can spend based on your income, because your income's not changing, only your payment will. Now your payment's $1,500. What does that do to the price of the house that you can afford?
I will do that. I will have that spreadsheet available certainly by next week for our discussion. Yeah. I think that would be interesting.
That's an interesting exercise. And that will show you what I'm talking about, and what builders face, and why builders are pulling back a lot is because they're selling payments.
Yeah.
And
oh, absolutely.
If interest rates go up to 3%, that $400,000 house is now $350,000. So every 1% affects it by about 10% on the price point of a house.
Yeah, so I will do that. I do not have that in this data. See, this is why I like sharing data with experts, because they give me great ideas. I will build that spreadsheet myself. The other thing I did, again, feedback from my audience, is there's actually a channel, Greg, talking about a 30-year mortgage at 1%. Can you imagine that?
Well, that would be hard to imagine. I don't know. Yeah, the government's probably the only one supplying that mortgage. The other thing is the 40-year mortgage. That's the other thing that we've heard a lot of talk about. Which other countries have 40-year mortgages? Yeah,
so I think a 40-year mortgage is coming. I absolutely think it's coming. I think it's years out, but I think it's coming. The other thing, I did a review of that video, and I said I could see 1.99, but I can't see 1%, because I think banks have to make a margin, right? They got to cover overhead. They got to do all these other things. But again, the audience asks, so I did it. So what I was thinking is, hey, at 1% interest, again, everything else being equal, this is part of my what if game, your payment goes down to 14%. But what I did here is I wanted to look at appreciation, because I know if rates go lower, values are going up, right? So what I did is, okay, what happens if, 1% interest, what would happen to payments if they went up 25%? So again, you're still healthy at 17% of gross. Again, we've seen 17% only here recently. What about 50% value increase? Well, again, because interest rates are so low, you're still only at 21%. And then, what the hell? I don't think I've done 75 before, but let's do it. Again, you're at 24%. Now you're getting kind of crazy. You're getting back to the 90s and 80s from affordability. But basically my point is, if a 30-year mortgages ever got to 1%, you want to be a homeowner, because values are going to explode higher. Is that fair?
Oh, absolutely. Homeowner, investor, whatever. Yeah.
Property is the more you own, the better, right? Oh, that's funny. So thank you for
look at cars. I mean, that's the only reason.
Yeah.
Cars can sell for $100,000 for an average SUV is because they're spreading payments out over 84 months now on vehicles.
It's crazy. Yeah. I don't see a 1% coming, but again, I had to put it out there. My big takeaway from this is, it's all interest rates. I mean, I knew interest rates were important. I just didn't know how important.
Well, it's the same thing for commercial. It's the exact same thing, and it always has been. They're income properties. It's all based on the cash flow. And see, that I understood that intuitively, because that's the market I grew up in.
Absolutely.
It was an investment property market. So it was all about cash flows, and everything was based on the income, net income the property would produce. Same thing with commercial. And then as you're buying a house, that's the first thing you do is you look at, what's your income, and you had that debt to income ratio, and you bought a house based on what you could afford. And it was, roughly 30% of your income is what you had to spend on your monthly payment, taxes, insurance, maintenance, the pity payment.
Yeah, exactly. Well, this has been a lot of fun for me, Greg. You have a YouTube channel that is blowing up. How can people find you, follow you, be part of your world?
Yeah, gregdickerson.com. All the links to all my social media are there. And I talk about entrepreneurship, real estate development, buying businesses, investing in markets, investing in cryptos, all kinds of stuff, everything entrepreneurship.
Yeah, you got to follow him. He is the entrepreneur. Thanks, buddy.